No, I didn't. Okay, sorry. The income plan and the investment plan need to work together. Okay, the investment plan needs to support the income plan. So there's a reason why I put the investment plan after the income plan, because first we need to decide what is our income need, what's going to be our deficit in retirement when we stop working and we start getting things, Social Security, pensions, or start taking required minimum distributions from our 401ks, etc. Now, how can we utilize our investment plan to support that need and close that gap? What I like to see is for my clients to have a reliable income from the beginning of their retirement until the last chapter of their life, because that gives them what it gives you.
Security.
Peace of mind, security, an absolute certainty, and it also gives you so much freedom. You're not afraid to go buy the new house or go on that trip with your family of 11.
You have to sit down. You have to sit down and put all your figures together. And many times it takes sitting down with another person to help you realize.
Yes. So I also have to say, if you're just tuning in, you're watching or listening to and watching live on Facebook, the Mindie Molina Show. And I'm joined here with Frank Borelli, who is also a licensed financial advisor and insurance agent, and my lovely Morgan.
Hello.
And you can reach us here at the radio station at 772-221-1100. That's 772-221-1100 if you'd like to call in with a question.
Yeah, any questions or even any stories that you feel are, go along with what we're talking about today and how important planning is, because the more we can get this message across, the better, because we believe in it that much. And I don't want them to just take our word for it. Hearing from you also just reaffirms what we're saying. So 772-221-1100. I am Mindie Molina, and you can find me online if you want to follow along with all of our publications, including Facebook Live, which we do with the show, YouTube, Instagram, Twitter, LinkedIn. We have a podcast. You can go on our website where you can do a risk tolerance questionnaire. You can get MindieMolina.com with an IE, Mindie with an IE. And you can also find me on Newsmax, Amazon Books, Goodreads, ChristianBooks.com, where you can find my book, God Loves You, and There's Nothing Anyone Can Do About It. Or you can call our office at 772-872-6332.
What's the next step in our planning?
Investments. And there's so many different varieties of investments. Investments alone we could dive deep. So when we have your investment plan, now we're looking at where's this income going to come from? Your 401k, your IRAs, your 403bs, 457 accounts, any type of retirement account that you've been putting into, whether it's a Roth, a SEP, different types of IRAs, but also what I call non-qualified accounts. And what that is money that you've already paid taxes on. So there's pre-tax and after-tax dollars. And if you've already paid tax on these, then those are your non-qualified accounts. They don't qualify for income tax when you start taking distributions from those.
Roth IRAs is an example.
Yeah, or sale of a house if you get that, or just your savings. Maybe you've been stashing cash away in your savings account in a money market, but it's not in any type of IRA, nor will it become one.
There's some time requirements for the house sale.
Right? For tax purposes, is that what you mean? Yes. So let's talk about the different type of investment accounts that you can have and the different ways that you can strategize within those to take income. One is bonds. So you can have dividend paying stocks. You could have preferred stocks. You can have real estate investment trust, or also known as REITs. Or you can have, if you want, you can get funds, which most people do, that are appropriate for each of those segments. You can also take income as a growth or a capital appreciation and use that to take distributions. So you just grow the account in the market and you're just really looking for growth versus something that's actually going to give you income. So one of the biggest things with your investment plan in relation to income is this. So now we've just segued from those standard incomes, that reliable income that goes on forever, right? Pensions, annuity payments, Social Security. Those are really important. But now we're talking about the ones that are not guaranteed. Okay. And when you're taking money from your investment accounts, like the things that we're just talking about, those are not guaranteed. So my question is, okay, what could go wrong? What could go wrong if you just stay in the market and you stay in those types of investments? One of the things is this mystical word that I highly recommend you read up on called sequence of returns. And a person with the same amount of money that going into retirement at the same age, everything's the same with the exception, even their average rate of return, let's say over 10 years into retirement, is the same. Maybe it's 4%, both of them. But the only difference is that the rate of returns that they received over those 10-year periods, if you flip them, if one of them, the negative returns happen first, and the other one, the positive returns happen first, the one with the negative returns early on in retirement are at a huge disadvantage. Yeah, a huge disadvantage. Their retirement plan could essentially blow up. They could run out of money, which is people's biggest fear. But there are ways to protect yourself from that risk, because guess what? No one knows what the market's going to do when you decide to retire. You may decide to retire and then some catastrophic event happens, and which has happened in the past. I'm literally thinking of people that this has happened to.
It'll happen in the future.
Yeah, and retirement lasts how long? We're not retiring for 5 years here. We're talking about decades.
And the longer we're living these days, the longer that retirement time frame will be.
Some of the things that can go wrong include living longer than you expect. I've had some clients. I have some clients that, were already aging when I met them 10 years ago, and now they're still trucking along and doing awesome. And here's what they say: I didn't think I would live this long.
And if you're wanting to call into the program, you can call in at 772-221-1100. That's 772-221-1100 with any questions or stories you might like to share with us.
Thank you, Frank. And one of the things about being in the stock market and relying on that as your income source. So we're talking about your money's invested in various types of investments that are available to you. But the thing of it is variable is actually the key word, variable, because you don't have any certainty. It could be up, it could be down, which is absolutely fine. One of the reasons this strategy works well during what I call your accumulation phase. So there's two phases of a person's life when it comes to their investments and their finances. There's the accumulation phase, when you're working years, when you're accumulating assets and you're saving and you're growing your nest egg. You're not relying on any of it to support your lifestyle. You're growing it. The second is the distribution phase. And the distribution phase is when you really need to take things very serious, because you're relying on that to support your life. It becomes your job now. There's no going back. People will tell you.
And because some of these are government coded accounts, the qualified accounts, the IRAs,
Absolutely.
there begins to be required minimum distributions that you have no control over.
So when you have a 401k, when you have this retirement account that you've been contributing to, that you have not had to pay income taxes on all these years, which is wonderful. It's allowed you to roll that money up. I think they're great. Some people argue the differ, but what's important is that you understand you owe Uncle Sam money, and he's going to want his money. Eventually, he's going to let you go as long up to age 72 now. And then he's going to come to you and say, I'm ready to start seeing some of that.
These are some decisions that investors have to make, and that we help folks with trying to understand those realities. Where do I believe I'll be in a higher tax bracket in retirement, or will I am in a higher tax bracket currently?
Part of a tax plan is making sure that we want you to pay your taxes, obviously, but we don't want you to pay in a tax bracket that you shouldn't be paying in. We want you to pay all of your taxes in the lowest possible tax bracket. So meaning at the lowest cost possible. We want to save you money.
We're at historically low rates currently.
your income and investment plan should work hand in hand. And I think that's one of the biggest things. But one of the things that can go wrong, like we said, is not having certainty, not having guarantees, not having that promise that that money is going to come no matter how long you live. If you are 60 and you retire and you start taking income, we want to make sure that when you're 90, you can still get the same income or more because of inflation. And people are living longer, so you have to think past the present time when it comes to having these plans.
Goes back to the income. The longer I work, the more I can accumulate and invest. For folks sometimes thinking they'd like to get out of the income, stop working and go into retirement, and which would not allow them to invest as much or accumulate as much potentially that they could if they stood.
Are you saying because they retired
in
early?
The workforce. I want to get out. I want to stop working at 58.
Yeah.
But physically, maybe I could work for,
yeah.
another 3 or 4 or 5 years.
And that's where that, maybe it's a business, maybe it's another job. There's other opportunities once you retire. And I have a lot of clients that retired early.
If you live into your late 80s or 90s, could have consequences that you weren't thinking of.
But guess what? If you have a plan and you've already seen the numbers and you see exactly how it's going to play out, even in the worst case scenarios, and you're prepared for those.
Done adequate planning.
Why not? I have a gentleman down in Jupiter. He retired. He was able to retire in his 50s. Why? Because the numbers don't lie. And he's enjoying retirement right now, even though he wasn't sure that was even a possibility. But boy, wasn't he happy when he found out it was. And if he decides to do other things and take on other opportunities, he has that freedom. He doesn't have to stay in a career because, if you've been with a company for 20, 30 years, I know there's probably people listening that say, yeah, I would love to get out of here, but they don't know if they can or not.
One of the strategies, Mindie, I like talking about is, especially in the beginning of a new year, many people are experiencing pay raises potentially or receive bonuses. And my personal strategy to have people think about is spreading that extra income. Don't spend it all, right? That's probably not a really good idea. Spread it out. Pay down some debt if you have debt. Long-term savings or investing, put some there, and maybe some in emergency savings if that's not adequate. Thinking about spreading that extra income out and planning for it and not just letting it sit there and spend it.
Yes. So I like the word spend. And I know a lot of financial advisors like the word save. Save for retirement, save your money here, save your money there. And Frank is smiling because I can tell he likes that word too. But sometimes when we just use the word spend, if we use the word spend money on your retirement, spend money on your investments, and
on
even
your vacation plan,
and then when you do retire, you have money to spend. It just seems way more exciting. Save. It just, for me, I get more excited about spending money than I do saving. Maybe not everyone is that way.
Allocating.
All right, so back on track with the investment plan. So we have our income plan, we have our income strategy nailed down. We feel like no matter what happens in the world, we've got this. And we're going to retire and live happily ever after, right? So now we move into the investment plan. And what we have left over, say we already set aside the portion of our assets that we need to support our income plan. And now we're looking at the investment plan. All these different ways that you can invest your money. Cash, obviously, which a lot of people are in cash more than you believe. Certificates of deposit, stocks, bonds, variable annuities, fixed annuities, single premium annuities, mutual funds, cryptocurrency, index funds, commodities, exchange traded funds, preferred stocks, REITs, and I'm sure the list
precious metals
goes on and on. But when it comes to investing, let me narrow it down after all of that to just 3 ways, okay? You can invest for growth, you can invest for safety, and you can invest for income. These are the 3 worlds of investing. That's what we call it.
All at the same time.
But no, you really need to have a focus, okay? That's what planning is about. It's like, what are we trying to do with this money? And I feel like the society just wants to bring you in, like, here, I've saved up X amount of money. Let's say someone comes to me and they have $1 million and they say, well, I'm moderately conservative. Well, I don't like that broad stroke of planning. because now you're just taking all of the money and you're just pushing it in one direction. And I apologize, I have this dry cough, but I like to be able to say, this is the structure. We're going to allocate this much money to our income plan, and that is going to be for one of the three. What do you think it is?
Income.
Bingo.
Income, growth, or safety.
No, when we're talking about our income plan, what are we focused on when we talk about investments? Income. And then when we take what's left over, so what our risk tolerance might be for that income strategy could be completely different than now that we know that our income strategy is solid. Now we have this much money left over. Guess what? We might not feel like we have to be in such a safe environment. We might feel like now I can focus on growth more. Maybe I can go in this direction. So when we start to build a strategy and a plan, we really start to be able to allocate and move in a direction that's not just this generalized, like, oh, I think I'm moderate, conservative, or no, I'm aggressive. I want to be aggressive. So I like to be able to break it down and really make sense of the money and what it's going to be used for. And the best way to do that is to start with an income plan and then back into the equation and then say, all right, now we have this left over. How do you feel about that? The other way I like to look at money is with three other different allocations. And I'm going to let Frank say what they are. Do you have that slide pulled up?
Yep. Expenses, emergencies, and the nest egg. We got three E's there. Expenses, emergencies, and the nest egg. Funded by the expenses you will be funding by your income plan. You know, we're talking about your checking account, ongoing monthly expenses. And then in the emergencies, maybe unexpected mishaps, maintenance, comfort cash amount, and that amount may vary.
Okay, so I had to get some cough syrup in me. Thank you, Frank, for going through that. There's really three solid, money should be cyclical in your life, right? No matter how much you have. You have your basic expenses that's keeping the show going.
Otherwise known as a budget.
Yeah, the budget. And one, you know, people ask me sometimes, how much money do I need to retire? How much does a person need to retire? Well, it depends on you.
Personal question.
It depends on your budget. I have people who are retired that only need about $2,000 a month. I have people who retired who couldn't sleep at night if they didn't have $20,000 a month coming in. So it just, and then it builds from there. Having that, having your comfort is what matters, but it builds off of your budget, like you said. So the expense account, money's coming in, money's going out, money's coming in, money's going out. And it's just your checking, right? This is where your income comes in. It's no different in retirement. And then you need an emergency fund. The emergency fund tends to get overlooked, especially, I think, for the young, like pre-retirees or younger generation. We start accumulating some money. We got some money in the bank, and now we want to invest. But we forget that we actually need an emergency fund that's liquid, that's cash.
The transmission went out and the fridge broke in the same week.
Right.
And I got a hole in my roof.
And it's always, and what happens, this money is for mishaps. I call it the mishaps and maintenance. So all those things you said are maintenance. It's like these things are going to happen. You need to have cash on hand, ready to go. You don't need to be calling your advisor.
Across the country for, God forbid, something happens in the family.
Yes. Yeah. True point. The comfort cash is what I call it. It's an emergency fund. So don't forget to set aside cash. And I tell people, once you get that filled up, then come back and you're ready to invest.
We want to remind folks this is a call-in program. If you'd like to call in with your story or if you have any questions, you can reach us here at the station at 772-221-1100. 772-221-1100. This is a live broadcast.
The last one is the nest egg, which is the investments. That's where once you get to the point, let's get your expense part built and then your emergency fund built. And now we're ready to build a nest egg. Now we're ready to focus on what we're going to do with that, which starts with the income plan.
Right?
I'm sorry. What? No, they're not all in one basket. That's exactly right. That's exactly right. So remember, your investment plan needs to support your income plan first. I know I'm spending a lot of time on this first section of the process, but it's the most crucial section because it's going to dictate everything else that happens in retirement. And Warren Buffett said, I love this quote, "It's insane to risk what you have for what you don't need." And I believe in that. And how do we know what we're going to need? That all comes out in that income planning. So once we know what we're going to need, then we know what we can afford to take risk on.